Hey guys, it is Julie here with TipRanks, and today we're taking a look at two strong buy dividend stocks. So let's get into it. Alright guys, welcome back. Thank you all so much for being here. I do want to quickly apologize for my unexpected absence this past week. To be honest, I'm going through a lot of challenges in my personal life and just had to take a little bit of time there. But we are back today and we're going to be taking a look at two dividend stocks. Now these both come in with a strong buy consensus from Wall Street. So we're going to take a look at these companies, what it is that they do, and of course what analysts are predicting for their stock's future. Don't forget to also check out the TipRanks newsletter section, where you can get unique insights every single week from our Smart Investor and Dividend Investor newsletters. Links will be in the description down below. Now let's get right into these two strong buy dividend stocks. First up, we're taking a look at Brookfield Renewable Partners, trading under the ticker BEP. Their stock is currently priced just shy of $26 per share. Now, year to date, the stock is fairly flat and up 2.5%, but in the last few months, it's fallen over 14%, so we could be approaching a low here soon. Brookfield Renewable has a global footprint of diverse energy assets. Their portfolio includes a wide range of distributed energy and sustainable operations. They have conventional green energy projects such as wind, solar, and hydroelectric power generation systems. They boast renewable capacity across multiple technologies and continents, supported by a strong contract profile and best-in-class assets. Now, the name Brookfield might be familiar as they are one of the largest alternative investment firms in Canada. And Brookfield Asset Management owns a 60% interest in Brookfield Renewable Partners. This provides a solid financial underpinning for the energy company, allowing them to expand their power generating facilities and operate at utility-grade scales. Brookfield Renewable does pay a quarterly dividend, currently set at 33 cents per share for a dividend yield of 4.94%, which is well ahead of the sector average. Now do keep in mind that their stock has fallen a bit lately, so that number will look a bit higher. They did just report their latest quarterly earnings on August 4th, and while they did see increases year over year, they did miss analyst expectations, and this seems to be the norm for the company. For their Q2, they did report revenue of $1.16 billion and a loss per share of 10 cents, and that was 6 cents wider than analysts were anticipating. But they did deliver year-to-date double-digit FFO growth, and they also agreed to acquire Duke Energy Renewables, which is a scale operating platform generating strong cash flows. But despite missing on those earnings expectations, the stock does come in as a strong buy with 5 current analyst ratings. That is based on 4 buys and 1 hold. The average price target for the stock is over $35 per share, which would be a growth potential of 36% for the next year. Looking down below, we can see our most recent ratings coming in after that earnings report. On the low end, we do have a hold with an upside just below 5%, and then 2 recent buy ratings with upsides both over 30%. Our second strong buy dividend stock is Diamondback Energy. Their stock trades under the ticker FANG, or FANG, currently priced at just above $150 per share. Their stock has seen growth of nearly 19% year to date and has up 19.5% in just the last 3 months. Diamondback Energy is an independent oil and gas exploration and production firm based in Texas. They focus on unconventional onshore plays in both oil and natural gas, engaging in activities such as acquisition, development, exploration, and exploitation of these energy sources, primarily in the Permian Basin of West Texas. They employ a strategy of horizontal exploitation to maximize the value extracted from each well. And similar to Brookfield, they also pay their dividend on a quarterly basis. It currently stands at 84 cents per share, which gives them a dividend yield of 6%, once again well above that sector average. In their latest earnings report, they did see a year-over-year decline in both earnings and revenue. Earnings per share came in at $3.68, which was below analyst expectations, while revenue came in at $1.92 billion, which did surpass. But during the quarter, they did generate free cash flow of $547 million and increased their dividend by 5%. The FANG stock has gathered more attention from Wall Street than Brookfield. Their current strong buy rating is based on 13 current analyst ratings. That comes with 12 buys and 1 sell. The average price target of $173 would be an upside potential of nearly 15% for the next year. Looking down below at the most recent ratings, we do have all buys following that earnings report. A low-end sell rating comes from last month with a downside of 7%, several ratings around the 26% upside, and a high-end price target at 37% upside. So there we have 2 strong buy dividend stocks. Let me know your thoughts on these 2 companies in the comments down below. Do either of them pique your interest, or what are some of your other favorite dividend stocks at the moment? I always love hearing from you guys. Please keep in mind these videos are never a suggestion to buy or sell any specific stock, just providing some insight and entertainment. So please make sure you always do your own research and due diligence. Thanks so much for watching, guys. I hope you have a great day, and I'll see you back here next time.